The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Hundreds of billions of dollars in AI spending and $100 oil sending shockwaves through the markets. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Katie Greifeld.
And I'm Bailey Lipschultz. We're kicking you off to the closing bells here in the U.S., Katie, and it's a lot of red on the screen.
Yeah, it's not pretty out there. Let's take a look at the S&P 500. We're not quite at session lows, but we're getting closer, down about 1.4% right now. Your biggest weights in the index are Tesla and Alphabet, followed by Amazon. You can see that really coming through when you take a look at the NASDAQ 100, down by about 2% after the earnings we had last night, heading into Intel after the close today. Keep an eye on what's going on in Brent, though. We are back above $100 a barrel, rising about 6.8% today alone. That is pressuring yields higher across the curve. The 10-year Treasury yield now trading just a breath below 470, Bailey, higher by about 4 basis points.
Yeah, not a good picture. And let's look at some of the notable movers in today's trading. You kind of kicked off with two of them. Google right now down sharply, more than 6.7%. That is the worst day, or on track for its worst day since May of last year. Katie, wiping out, call it $265 billion in market value. What's that between friends? Tesla, as you mentioned, down right now about 14%, on pace to close at its lowest level since August of 2025. And you mentioned oil. Well, American Airlines down 7.6%. Guidance weaker than expected. They cut it on the cost of fuel. All the things that go into these flights are ultimately going to come out of someone's pocket.
Yeah, absolutely. You think about what we're seeing just in oil has plenty of ripple effects. Let's try to put everything together now with Mike Contopoulos. He is head of multi-asset macro investing over at Janus Henderson Investors. Mike, great to see you in person.
Great to see you, Katie.
So we have to start with AI, especially when you think about all those big red numbers that we have attached to the equity market right now. A lot of this comes down to the fear that we've been talking about for several quarters now, that all of this Capex, all of these hundreds of billions of dollars being funneled at AI, whether or not it's truly seeing the return that would justify some of the spending that we're seeing. And I wonder, when you take a look at what's going on in markets this day, this week, this month, whether this is the start of something more sustainable in terms of a sell-off, or whether this is just late summer indigestion.
I think it can be something that's more sustainable, Katie. I mean, listen, you've got a tremendous amount of spend out there on a technology where we don't really know what utilization is going to be, right? It sounds very familiar to me like the old CLEX of the late 1990s and early 2000s, building out infrastructure for the internet, expecting a tremendous amount of traffic that didn't come for several years. Now it came, and it was revolutionary. And so I'm not an AI denier. It's not that we don't like the technology. It's not that we don't think it won't be transformational. But I don't think we really quite know yet whether or not the demand is going to be there to justify the spend. The other thing, and I'm not even sure the market's fully woken up to this yet, is that the amount of spend on data centers and AI effectively assumes that we are at peak innovation. Right? And so if you're a technology believer, if you think that innovation is constant, technology is constantly innovating and changing, then compute power is going to shrink, right? You're going to have data centers that are the size of Manhattan be data centers the size of this room. You're going to see more efficient models. And as we know, right, things evolve over time, and all this spend could be, I wouldn't say worthless, but certainly not profitable anytime soon.
I think it's a great point that you think about, as you mentioned, just the physical footprint that we're talking about with these data centers. Things tend to get smaller. Technology tends to get smaller. So who knows what we'll be seeing in a few years. Someone made the good point on this program that the version of AI that we're using right now is probably going to be the worst version of AI we use in our lifetimes. But you think about the potential ripple effects here. I mean, you think about all of that Capex sort of funding the rest of the market. Really, if we started to see some sort of pullback from these hyperscalers, what does that potential daisy chain look like? Is that something that you're discussing?
It is a little bit. I mean, you certainly have seen some of that follow through in the industrial sector here in the U.S. But, when we look out across the globe, there's so much growth out there that are not just the hyperscalers. If you look at the All-Country World Index and you look at all of the growers of earnings growth, greater than 25%. Right? So projected earnings growth greater than 25% for every company in the All-Country World Index. A hyperscaler, there's only one in the top 200. So there are 199 other growers of greater than 25% earnings growth in the ACWI that, that's phenomenal. That's phenomenal. So this is not an AI story. AI is not touching all 199 of those companies.
No, but how much are AI adjacent? Because when I look at the market, maybe you're not a semiconductor company, but if you're building out the infrastructure or powering the HVACs that cool data centers, even if you're not necessarily an AI company, quote unquote, you're still benefiting from that spend.
Certainly on the industrial sector, that's the case. That's certainly been the case, whether it be the HVAC company, the ball bearing company. Absolutely. I mean, you've definitely started to see that in the industrial space, but you're seeing growth much more than industrials. You're seeing it across a broad swath of sectors and a lot of regions as well. I mean, when you look to China, when you look to LATAM, when you look to sort of other areas, those are commodity producers. They're not necessarily areas of the world that are touched by AI in the same way that the U.S. is, certainly not from the perspective of building data centers and things of that nature. You're seeing growth, and even in Europe, you're seeing growth. And so, and that's not a big center for hyperscalers and data centers and whatnot. So it's not just a U.S. story; it's a global story, and you're starting to see that growth throughout the world. Yes, within the industrial space, having to do with AI and the build out there, but outside of that as well.
And the other big story of the day, obviously, is Brent back above $100 a barrel, crude back north of 90, right now at 90, just south of $92 a barrel. Concerning?
Yeah, it's a little concerning. I mean, I think, we've been in the camp, as you guys know, for quite a while, that rates are probably going to go up. They're not necessarily going to go down. I've been a big believer that you're not going to see, a sustained 3 handle on the 10-year unless you're in recession. And that you are much more likely to hit 5% on the 10-year. And the higher oil goes, the higher those chances become. Now remember, you have higher oil at a time when jobless claims are essentially the lowest since the 1960s. Earnings growth in the U.S. is hovering around 20%. Credit spreads are at all-time tights. Economic growth is reasonably strong. Like there's no reason for, and inflation, as we know, is nowhere near target. So I think all of this conspires, including energy prices and oil prices, to a higher 10-year and higher rates.
What do you think this means for the Fed? We're less than a week out from Kevin Warsh's second meeting as Fed chair. And, I know they're paying attention to core, et cetera, but you think about the influence of much higher energy bills that's going to affect consumer behavior.
Yeah, it could. It hasn't yet. When you look at the data and you look at the consumer's gasoline spend relative to income, for example, it's very average at best. It hasn't really exploded because income has gone up quite a bit over the last several years. And so I think that's been the one big surprise since the Iranian war, is that the higher oil prices hasn't really dented consumption yet. Now, could it? Of course it could. But if I'm the Fed, I have to take that as a data point. I have to sit there and say, okay, my prior may have been that this was going to hurt consumption, but it hasn't. Growth is still strong. Inflation is still high. What tools do you have? It's rates, and that's it. And so, I've actually been reasonably impressed with Chair Warsh in terms of his first meeting and some of the comments he's made. I think he's going to be serious about inflation. It's clear that the Fed governors are going to be serious about inflation. And we think there's a pretty good chance they'll be hiking at some point this year for sure.
All right. Well, Mike, that's a good place to leave it. Great to get some time with you. That is Mike Contopoulos. He is head of multi-asset macro investing over at Janus Henderson Investors. Now, coming up, an important juncture for private markets. PGIM's Matt Harvey reveals where the opportunities lie and why direct lending does not present systemic risk.
Plus, full coverage of Intel earnings due after the bell today. Seaport, Goldberg, and OMNI is
and the United Nations hosting a town hall in its search for the next UN Secretary General. United Nations Foundation CEO Elizabeth Cousens will join to discuss what's next for the organization. All that and more coming up. This is The Close. Ten-year yields hitting the highest level since January 2025 as tensions rise in the Middle East. Now, the move comes amid an uncertain macro backdrop with inflation remaining elevated. Joining us now to discuss, I'm pleased to say, is Dr. Atsi Sheth. She is Chief Credit Officer over at Moody's Ratings, joining us on set. Great to have you with us. So you think about what we're seeing when it comes to the Treasury curve, these longer dated yields rising, but really a rise across the curve. How structural do you think this could be?
It is absolutely structural, in our opinion. We think we've entered a new macro regime. And by macro regime, I define it as having started a few years ago and very different from, say, the decade we saw after the global financial crisis. What's important about this macro regime? Structurally higher inflation, higher interest rates as a result, but also wider fiscal deficits, and the possibility that the global uncertainty that you see will be socialized further and fall onto the government balance sheet.
Yeah, and I'd love to get into those drivers a little bit more because, I'm taking a look at your notes. You also mentioned the fact that when we take a look at the credit market, we are seeing much, much more issuance there. And, I wonder within that potpourri of what we're seeing when it comes to structurally higher inflation, higher policy rates as a result, where would you sort of rank what we're seeing on the debt issuance side?
Yeah, it's a great question, and I'll tell you an anecdote. So we were sitting at Moody's, a group of credit specialists talking about how sovereign yields are now up to levels, whether it's the US, whether it's Japan, whether it's Europe, they're up to levels that you saw before the global financial crisis, so quite high. At the same time, high yield spreads, at historic lows. So the question we said, well, which market is wrong? Is the sovereign market misjudging where rates should go, or is the high yield market misjudging where rates should go? And we decided that actually both these are telling the same story. So to your point, the sovereign market is actually pricing in the geopolitical uncertainty, the macro uncertainty. What we're seeing in the credit market is a little bit of diversification of funding. So you see that lower rated entities migrating into the private credit markets, which just creates a diverse source of funding. You also see great hopes, until today perhaps, of this return on Capex investment from technology, and that sort of gives them some succor. Earnings have been pretty solid so far. So the corporate credit market is looking at solid earnings, the hope of productivity and sort of returns on investment. It's looking at migration into other areas of funding besides the bond market. And importantly, it's expecting that if financial turbulence sort of shakes all of this up, the sovereign will step in some way through monetary or fiscal policy.
Well, you mentioned a rotation into private credit, which seems to be kind of the boogeyman, or at least has been for a better part of this year. Is that concerning? Like, what do you take away from a rotation into a market that has had its share of downsides? Yeah,
so on the one hand, any diversification in your funding sources is a positive thing because it just allows both borrowers and lenders to find new ways of doing what they want to do, in the sense of where private credit itself is getting its own funding. Some of it tends to be very long-term capital from pension funds, insurance funds. So you could say that is exactly the kind of capital that you want to go into sort of long-term financing. So that's the good side. On the sort of side of concern is opacity around valuation, concerns around liquidity, and I think we've seen those concerns play out, but the more sort of light we shine on those issues, the less concerning they become.
Well, wondering, to come back to the point you made on the sovereign aspect, when I look at kind of where we are in 2026 and you compare it to kind of any stretch of history, it kind of is jittery, right? So when you look at what you're seeing and kind of what's being baked into the market, is that a cause for concern for the rest of this year, for 2027?
I'd look at it two ways. One is the market signaling that fiscal deficits, which are wide today, are likely not going to narrow in the near future? And I think the market's got that right. They're not expecting a narrowing. Is the market signaling, so what we're seeing in sovereign yields is stuff that's going on elsewhere. The market signaling that inflation is not going down in a hurry. Absolutely, yes. Consequently, higher rates. What is maybe something to think about is that if you look at the last 5 years, we've had shock after shock after shock, pandemic, geopolitics, oil prices, supply shocks, and sovereigns have stepped in to fund, whatever it is that needs to be socialized. The next shock comes, the fiscal capacity to do that is just diminished.
Yeah, and there's a lot of uncertainty around that, and we'll have you definitely back on the program to break it down when that does happen. That is Dr. Atsi Sheth. She is the Chief Credit Officer over at Moody's Ratings. Well, coming up, Alphabet's AI spend sending shockwaves through the AI trade. We'll unpack the move next. This is The Close on Bloomberg.
All right, it's time now for our top calls. Look at some of the big movers on the back of analyst recommendations. And first up, Morgan Stanley less than electrified about Tesla's latest earnings, dropping their price target down to $400 from $417, while keeping an equal weight rating. The firm says that Tesla's accelerating Capex spend is a, quote, necessary investment to maintain its leadership in autonomy and robotics, but that investors need to see tangible milestones in its robotaxi rollout and its Optimus robot program. Shares down 14%. Next in line, Wolfe Research dialing up its rating on AT&T, going from peer perform to outperform. The analyst says that results included improving churn despite a price increase, strong account growth, share buyback acceleration, and a clearer path to EBITDA upside in 2026, all pointing to a recovery for the stock. Shares down slightly. And finally, Riot Platforms, Morgan Stanley initiating coverage of the Bitcoin miner turned data center operator with an overweight rating and a $36 price target. The firm is encouraged by Riot signing a lease with strong economics this summer at certain facilities due to their site size and grid interconnection, noting that they still have more Bitcoin mining facilities that are ripe for conversion. Shares currently higher by about 1.7%. And Bailey, those are some of our top calls.
Yeah, well, Katie, we're watching the granddaddy of them all. Alphabet shares down 7% on pace for their worst day since May of last year. AI spending continues to be a thorn in that company's side. And joining us live to break it down is Lloyd Walmsley. He is Managing Director and Senior Equity Research Analyst at Mizuho. Covers the stock with an outperform rating and a price target of $460. Well, Lloyd, right now it's trading at $318. What is Wall Street missing after this results?
Yeah, look, I think to some extent we're seeing a perfect storm where the company had, a less than clean quarter. Some things were extraordinarily positive, some things are a little messy, and we came into this with a elevated valuation, and it's also happening at the same time as like this escalating conflict in the Middle East, rising oil prices, rising interest rates, causing a little bit of a risk off across tech. Like those things are generally not good for tech. But the quarter itself had some really positive signs. I mean, the cloud business accelerating massively, the margins coming in much better on the cloud side. I think it's less the Capex upside, more the environment we're in with sort of the macro stuff, and then the search business. I mean, it was the first time in several quarters they didn't beat the number handily, and they talked up tough comps in the second half. And when you actually look at where the consensus is modeling the core search business for next year, growth is a little bit punchy. Coming into the quarter last night, consensus was modeling 13% for next year growth. It moved down to 12. We were at 11 going into the quarter. So I think some of this is just the core business, which has been doing really well, is just starting to slow down a little bit.
And Lloyd, we saw monthly active users of the company's Gemini AI system totaling 950 million. That's above estimates, but below what we saw in the first quarter. Are we starting to see some of this spending and this vision of how Gemini fits into the AI stack play out?
Look, I mean, when you look at the cloud revenue, they did 82% growth in cloud revenue. Consensus was modeling 65. I mean, that's just an extraordinary number. We actually think it will accelerate further next quarter. And so they're seeing just unbelievable demand for AI. And so I think we have a lot of evidence that there is a healthy ROI on this spend. And they're investing, they're leaning in to meet that demand. So I think that all checks out from our vantage point.
And I'm interested to what you make of, some of the fundraising that they've put through when it comes to Alphabet, both in the debt markets, but also when it comes to their equity raises as well. I mean, how are you factoring that into, your analysis of this company?
And when they did the equity raise, it caught everybody off guard. I mean, this is a company that still is very under-levered, and one would think they have plenty of debt capacity. Why are they tapping equity markets? And, we are by no means fixed income experts, but talking to our colleagues who are, there's certainly more capacity for any individual hyperscaler to raise more debt. There's plenty of of sort of leverage ratio capacity. The challenge is the dollar magnitude of what these companies are raising when aggregated is starting to become a meaningful portion of the corporate bond market. And so, sure, if Google wanted to add another 100 billion of debt, 200 billion of debt, in and of itself, that doesn't look like it would be a problem for credit ratings for fixed income investors. But when all of them start to put bigger and bigger numbers, you're talking about almost the size of the entire corporate bond market. And so, I don't think it's a leverage issue. I think it's just the quantum of dollars. And so what we're seeing is they're tapping convert markets, equity markets. And I think it makes sense. I also think that we're done for the time being on the equity side, at least at Alphabet, and that they will be raising debt to fund incremental Capex over the next year or so. And I think there's capacity to do that, but right. There is a little bit of indigestion in the fixed income markets. We're seeing that today.
Yeah, you're certainly seeing that also in tech sector spreads over the last couple of months. We only have about a minute left with you, Lloyd, but part of the reason that we are so focused on Alphabet earnings is because we're expecting them to sort of set the tone for the rest of the Magnificent Seven, for the rest of the hyperscalers. And I mean, if you think about what we learned last night, what we're seeing in the stocks today, it seems like AI Capex scrutiny is going to be once again the story of earnings.
Well, and what I think is out there is everyone we speak to in the investment world is expecting Capex to go up. And so in our minds, the biggest surprise this quarter was the magnitude of revenue surprise and margin surprise at Google Cloud. And so in our minds, that's very good for the broader AI complex, right? The ROI is coming through, the demand is there. And so it makes sense to be building into that in our minds. I would also say it does. I think it's still very early in broader enterprise adoption. I mean, right. I look at this when I talk to CEOs in our own company. We're just starting to really leverage this stuff.
All right, Lloyd, that's a good place to leave it. Really appreciate you joining us. That is Lloyd Walmsley of Mizuho. Now, coming up, we're at an important moment in private markets. That is according to Matt Harvey. He is head of middle market direct lending over at PGIM. He joins us next. This is The Close. It's about 3:30 p.m. in New York. This is the countdown to The Close. I'm Katie Greifeld.
And I'm Bailey Lipschultz.
And we are keeping an eye on earnings. A lot of focus on tech, of course, but it's not all tech. We're hearing from a lot of these asset managers, these alternative asset managers, and take a look at Blackstone. Shares up slightly today after reporting actually a pretty big jump when it comes to profits.
Yeah, it's a pretty solid report and gives the opportunity for management to really interact with Wall Street, interact with us in the media, and really talk about the story and try to shed a little bit of light on how the business is operating underneath the hood. Because, Katie, you got to remember, even as we look towards a Blue Owl and Ares or an Apollo results, Blue Owl down 39% year to date, Ares down 25%, and Carlyle down 25%, Katie.
Yeah, absolutely. It's going to be interesting, particularly to hear from Blue Owl. You think about all that private credit indigestion that we saw at the start of the year, the first half of the year. Blue Owl really in the epicenter, those results coming July 30th. But let's keep this discussion going with Matt Harvey. He is head of middle market direct lending over at PGIM. He joins us now. Matt, great to have you with us. We want to dig into that middle market, but first, just give us a lay of the land here, because we're sitting here at the end of July, and what an interesting couple of months the private credit industry has had. And I wonder where you think we are in that story.
Great to be here, Katie. It sure has. It certainly has been a moment where the industry has been tested to some extent in certain structures anyway. And what we see is a very bullish outlook, because that bullish outlook starts with supply. Structurally, there are more issuers every day coming to the private credit market. It's happening in the sub-investment grade world of direct lending, where I sit. It's happening in investment grade credit, infrastructure credit, asset-based finance. And the other thing that we see settling down a bit is the question of flows. And you mentioned some of the retail vehicles out there and managers who manage those. We're actually seeing those trends improve a bit in the second quarter. If you look at the second quarter, redemptions against subscriptions were roughly flat. And we think that's a sign of confidence for the marketplace as demand builds back in for these assets that are showing strong value for investors.
And let's talk a little bit about the middle markets. Of course, that's your area of specialty. And I wonder, what you're seeing from where you sit, because you think about, middle market PE transactions. They've been a little bit slow as of late. And when it comes to the direct lending side, what are you seeing?
Sure. We're seeing improving supply. I think what the market has been sort of constrained by the last couple of years is an ever-moving target of economic or geopolitical uncertainty. And what's happened during that time is, you mentioned private equity buyouts. It means private equity inventory has aged. If you look at the M&A pace today, it would take 9 years to clear that level of private equity inventory in portfolios. At the same time, we see the adoption curve increasing outside of private equity sponsored businesses. You referenced the middle market. That's where we focus at PGIM. We think there are 200,000 addressable issuers in the United States middle market. The private equity penetration rate today is only 10%. But I think the bigger story is if you can access the other 90% that are non-sponsored family-owned companies going through event-driven recapitalizations, generational transfers, et cetera, it opens up a huge amount of supply. And I think that's where, when you hear from managers like us about the opportunity, that's where we really see a much bigger picture than what the industry has historically focused upon.
Well, Matt, when you're looking at some of those businesses, as you mentioned, non-sponsored, family or founder-led operations, who's the net buyer for private credit for that type of vehicle? And is there any type of scar tissue around what we've seen over the last few months?
Well, I think that's the beauty of that market, and I'll frame it in two ways. Number one, the buyer is agnostic. I think the buyer can be an investor in a retail evergreen vehicle. It could be a large insurance company. It can be a pension fund in a traditional closed-end fund, because ultimately what we're doing is we're creating an asset that we originate bilaterally, and we're offering an excess return for that asset by trading off liquidity. And if you run an asset liability matching program like an insurance company, or if you're just seeking higher dividend yields like a high net worth retail investor, that's very valuable. The other dimension that we think is really powerful, actually, is this question of a unique asset. The middle market is stocked with real economy businesses. We have a much larger issuer set to select from, and that means we can create lesser concentrations than you have in the broader capital markets. Take AI and data centers. It's been a theme throughout of the year, clearly. The investment grade bond market, I think, in terms of exposure to those issuers, has increased dramatically over the last 12 months. In the middle market, we see some adjacency effects of that in a pull way that are good for those issuers. But by and large, you have a much larger portfolio that's well diversified across real economy basic businesses, and that's what we see there.
Well, Matt, just to kind of dive into some of those opportunities, where are you seeing clients or potential clients really wanting to kind of knock on your door and say, hey, we want to access this market, help us structure those deals? Is it for companies in the industrial space, or is it more consumer? Where are you seeing that activity?
All of the above, really. I'd say where it's not is there is an indigestion effect on traditional software businesses, and because there is a question on artificial intelligence disruption and how deep that will go, clearly. There are also many businesses that we believe are enabled by AI. And so the question of where do investors want to see the assets? Well, they may already have exposure or concentrations elsewhere in those two sectors. They'd like to see assets actually in businesses like food and beverage, consumer staples, landscaping businesses. These are basic businesses that everyday Americans touch and feel. Yet we believe if we can find them and structure them appropriately, offer institutional grade lending opportunities, and it creates a more complementary portfolio. And that really is the key for many of our investors right now who are looking at the middle market direct lending space.
And Matt, just back to the private credit landscape more broadly. We opened this conversation talking about how it was certain vehicles that really got caught up when it comes to all of those retail redemptions that we saw towards the first half of the year. There's a really interesting story on the terminal today that private credit is really trying to get away from the term semi-liquid. When you think about, again, some of those fund structures where really we saw the heaviest outflow requests from. And I wonder, just what you make of the term overall and some of the names and the adjectives that have been applied to these fund vehicles that have been more marketed towards that retail crowd.
Right. Well, I think it's a good point because ultimately the underlying assets are not semi-liquid. They are illiquid. And I think that that's something that we in the industry need to continue to make clear for the investors. You're trading liquidity for excess return, and the manager can apply their own emphasis on how they monetize that excess return. From a portfolio and then product standpoint, I think what you have to do is you have to make sure the investor understands how to get redemptions over time, and emphasizing the point of over time and the mechanical delivery of that, because you lose the excess value if you try to make the redemption quickly, hence the gates. That's part of the product design. We think that's a feature, not a bug. And we think that's very important. So whether that has a connotation of semi-liquid in an investor's mind, maybe that should just mean you have a structured way of getting redemptions over time. There is the ability to do that, but in any one quarter or period, it may be hard to do that at a value that you think is optimal, and that's where the redemption gates come into play.
Yeah, always a great time to connect. Thank you so much, Matt Harvey, head of middle market direct lending over at PGIM. Well, coming up, American Airlines hitting some turbulence today after slashing its outlook. Stock down more than 8%. We'll break down the move in today's Stock of the Hour. This is The Close on Bloomberg. Shares of American Airlines down 8%, their biggest drop since, well, they reported earnings this time last year. That does come after the airline now is forecasting negative earnings per share in the third quarter thanks to higher fuel costs. Here to break it down for us is Bloomberg's Sri Taylor. So, Sri, is this an example of a company hiding behind the war and volatility around oil, or what's the underlying story?
Well, American Airlines has been struggling with, being profitable for a little bit. It's kind of just been breaking even for at least a couple of years now. So it's trying to kind of get ahead with its premium revenue and kind of, pad up all of the, loss that it's seen from the higher fuel expenses. But it's, just not getting there. And that's why we're seeing that guidance, even lower for a second time so far this year.
Yeah, and I mean, Bailey asked the right question, which is, are they using oil prices, energy prices as an excuse? Because you think about, some of the division that American Airlines has had with its pilots, its flight attendants, as you reported on earlier this year, basically blaming the CEO and management for what they see as basically missteps.
It's definitely a good distraction. I think that American has had, a spate of issues, like you said, Katie, from, issues with management from the pilots and the flight attendants and, strategy missteps and just kind of being late to the premium game, like way far behind Delta and United and even Southwest, who is kind of, just a bit ahead of them in innovation. So this is kind of a good distraction to be like, okay, well, this is a setback. Everyone else is struggling. But American, even in a pretty decent fuel cost environment, still has a lot of work to do.
Yeah, just looking at the share performance, American down 11% year to date, alongside Alaska Air down 12%, but that stands opposite of Delta up 18% and United up more than 2.5%. Where we are right now in this earnings season, what's next for the airlines group, and is it going to be a tale of talking about the Iran war, or will we see other companies really talking up the demand?
So we've kind of been through all the network carriers so far. So next we have those lower cost carriers. We have Frontier, we have JetBlue, which is more of a value carrier, and Allegiant. So, we've saw Spirit's demise earlier this year, and we're going to really see how hard those lower cost carriers were hit and just, what kind of environment is this for them. But as for the network carriers, the Americans, the majors, this second half is more of, okay, how long can this strong demand for premium travel keep you afloat? Even as, we've seen fuel costs go up and down just in the past 3 weeks. So, you can't really predict the second half. So I think Wall Street was pretty frustrated with the, either they're reaffirming guidance or they're bringing it down.
Absolutely. Well, American Airlines shares currently down about 7.9%. Shri, really appreciate your reporting That is Shri Taylor. She is a U.S. airlines reporter for Bloomberg News. Meanwhile, you take a look at these broader markets right now. We are in sell-off mode and then some. The S&P 500 down about 1.5%. And Bailey, we know who to blame. It's big tech.
Well, it's funny, it's big tech, but we're also looking at a market where the semiconductors index is down more than 1.4%. So you're looking at weakness for the companies that should be benefiting from Google spending.
That's where the money's going, but you're not seeing that in the share performance. We're going to put it all together next and drive you to the closing bells with Nelson Yu. He is head of equities over at AllianceBernstein. That conversation coming up after the break. This is The Close on Bloomberg. Less than 10 minutes to go until the closing bells ring. I'm Katie Greifeld.
And I'm Bailey Lipschultz. Katie, ending the day on a sour note. S&P down close to 1.5%. It really seems like a sell-off across the board for most U.S. equities.
Yeah, absolutely. I mean, you think about the S&P 500 right now, you have more than 300 names in the red. But as evidenced by the NASDAQ 100, a lot of those names fall into the tech bucket. Tesla, Alphabet, Amazon, Nvidia, Microsoft, some of your biggest weights on the index right now. Probably doesn't help sentiment matters that take a look at the lone green spot on that screen.
Yeah.
Brent higher.
Triple digits, Katie. I thought the war was over. I thought that crude oil and Brent oil were going to go back down and life was going to be swell, but not so fast.
Yeah, no, it's pretty interesting to think that we're back at $100 a barrel on Brent, and certainly the pop we're seeing today higher by 6.5%, sending a lot of jitters through the bond market, and you can see that in the 10-year Treasury yield higher by 5 to about 5 basis points right now, towing the line of 470 or so. For more market analysis, though, let's welcome in Nelson Yu now. He is the head of equities over at AllianceBernstein. Nelson, great to have you on set with us. And there's a lot to get into here, but I think we have to start with tech because we heard from Alphabet, we heard from Tesla, and really across the board, it's this focus on AI spend. And the question that we've been asking for over a year now, when are we going to see the returns that sort of justify the spend that we're seeing? And I mean, just taking a look at the market reaction today, it doesn't look like that question has been answered yet.
No, it's certainly the $2 trillion question that's overhanging the market. And I think today, the market action really is just a microcosm of what we've been going through all year. It really is a one-dimensional market, just in terms of, is AI going to work? Is it not going to work? And I think that really has investors quite paralyzed in terms of what to do from here.
Yeah, and it seems like an issue of timelines, too, because I feel like, you ask most people about AI, and a lot of folks would agree that it's going to be transformative, but who knows if that's next year, if that's in 5 years, if that's in 10 years. The list goes on here. And I wonder, as an investor, how do you approach that question? How do you approach markets at this juncture where you are having these very urgent and existential questions being asked?
Yeah. Well, I think a lens that we have to look at is that quality lens. And I know quality, we've been talking about it all year in terms of how much quality has underperformed as an investment style. But if you think about the definition of quality, it really is the fundamental piece of how we have to look at the market today. The definition is really about companies able to durably earn returns above their weighted average cost of capital. That's really important today because the cost of capital is higher, but the question about whether they can earn those returns. You've got Capex numbers that have been growing at 70-75% for 3 years now among the hyperscalers. We're seeing that growth start to peter out with the growth decelerating. Next year, we're forecasting about 40% growth, even despite what we saw from Alphabet yesterday. And the next year after that, we're seeing about 20% Capex growth. But that's still growing. And so the big question is really who can generate that ROI? And really, it's a question of who's going to blink first.
But I think the interesting thing that I want your thought on is Alphabet now spending $205 billion. It seemed like this was a market that was going to be predicated on hyperscalers still spending. They're coming out saying we're going to keep spending, and the market pulls back. Semiconductors are under pressure. Is that driven by some of the macro thematics, or is this a market that's trying to digest a number of things?
I think it's a market trying to digest a number of things. But one of the most troubling things about that $205 billion incremental spend is actually why that spending increased. That spending increased because memory prices are up. And if I think about 1 quarter ago when Microsoft announced an incremental $25 billion of Capex, $20 billion of that was just because memory prices were higher. So they're not producing anything more. They're just trying to keep pace.
Is it concerning that the SOX index has moved less than 1% only 4 times since the start of June? It looks like an EKG.
Right. It certainly tells you how crowded this space is. And I think actually, Katie, to your question earlier, how does an investor invest in areas like this? First of all, I think investing in memory at this point, it's too volatile, and you have to size that appropriately. This is not where you want to spend most of your risk budget. Where you want to be spending your risk budget is actually what the market is providing you. The market is broadening. And if you look throughout the course of the year, what we've seen is significant earnings revisions. The breadth of earnings revisions we've seen this year is the highest we've ever seen in the last couple decades. And so, but 80% of the returns is still driven by semis and technology. So the market actually, the opportunities are opening up. The market just hasn't paid attention to it yet.
And I do want to go a little bit cross-asset here because you are head of equities over at AllianceBernstein, and it really feels like, as you said, we're talking about a one-dimensional equity market. It's sort of marching to its own drum. That drum is AI. And then you think about what's happening in energy markets, particularly today, and what's happening in bond markets. It kind of feels divorced from each other. And I wonder, in your seat, what sort of signals you are taking from fixed income at this moment as we start to see yields get to their highest levels in years here?
Right. I talk to my fixed income colleagues quite often and really get their perspectives in terms of where they think yields are going. Generally, we're actually pretty constructive on yields. We actually think inflation has been coming down. If you look at the labor markets, we're not out of control. If anything, the labor market is weakening. But so the direction of travel, we still think, is that rates can come down from here, or at least there's no rationale for raising rates much higher. That being said, I think the cost of capital, this higher for longer narrative that's been in the market, I think that is still something that equity investors have to be thinking about. And again, that's why I go back to this quality lens in terms of understanding that this is a force that we haven't had to consider for the last decade when rates were zero and cost of capital was free. And this is why I think what we need to do is we need to look more broadly in terms of what's going to provide that quality. Where I think the definition of quality remains the same, but where we're looking for quality now has changed. Right. We're seeing much more quality and durable types of profitability in what I call productivity enablers. That's industrial automation, that's specialized manufacturing, healthcare, even capital markets.
All right, Nelson, that's a good place to leave it. Really appreciate you stopping by the studio for us. That is Nelson Yu. He is head of equities over at AllianceBernstein as we count down to that close. And we know that coming up shortly after the bells, Bailey, Intel results, sort of the next big litmus test for this market.
The next big litmus test, and just looking at the options market, implying a 12% move, Katie Greifeld. Buckle up.
It's going to be fun, and we are going to walk you through all of the headlines as we get them with our global simulcast, with our radio friends. It starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
About 2 minutes away from the end of the trading day, Katie Greifeld alongside me is Bailey Lipschultz in for Romaine Bostic. And here to help take us through the closing bell, it's a global simulcast. We're joined now by Carol Masser and Tim Stenovic. We bring together all of our various audiences, Carol, and pretty big sell-off today after what we heard from Alphabet and Tesla and IBM after the bell last night.
Makes you wonder what Intel's going to deliver in just a few minutes. I'm looking at a SOX where most of the names are down again, and we'll see what we get from Intel in terms of what it has to say about its outlook and any AI commentary. That stock, by the way, down about 2.3% heading into earnings.
Yeah, no question.
For today.
No question mega cap tech is certainly half of the backdrop for today's market. The other half, I would say, is what's happening when it comes to oil prices and concerns about inflationary pressures there, Bailey. I mean, you got Brent above $100 a barrel at one point today, now just below it, but up another 6% today, and WTI the domestic benchmark up more than 5%.
Yeah, Tim, it feels like a market that the last thing they needed after the prints we saw yesterday evening was oil continuing to rip higher. So it does seem like you're kind of getting hit from both sides if you're an equity investor, in particular if you're an investor who's been riding this tech wave, Katie.
Yeah, really nowhere to hide because you think about the sell-off that is fueling when it comes to the bond market. Yields higher across the curve. We're talking about levels we haven't seen since January 2025 when it comes to the 10-year Treasury yield. So not much in the way of havens right now. But let's take a look at how we're going to finish up on the day when it comes to this equity market on this Thursday. The S&P 500, it will finish off the lows, but that's not saying much because it's still down about 1.2%. Most of that pain was felt when it comes to big tech and was felt by the NASDAQ, down by about 2.2%. The Dow Jones, I guess that's your relative outperformer, our friend, the price-weighted index, lower by about 1% or so. And small caps as well, Carol, falling on the day.
Warms my heart when you talk about the Dow. S&P 500, 213 names, guys, higher today, 290 to the downside, Katie.
And let's take a look at the sector level as well, because bad breath across the board, at least if you're looking for gains. Industrials, that was your outperformer on the day, 1.8% higher. Healthcare higher as well. Just 4 sectors in the green. In terms of what didn't do too hot today, it's probably no surprise. You had communication services, consumer discretionary, consumer staples, and then big tech really weighing down this market.
All right, folks, as we await Intel earnings, let me just go to quickly some of the gainers in today's session. Got to talk about the defense area. We did see some outperformance in those names. Lockheed Martin shares up the most since 2001 intraday after the company. Let's go to Intel.
Yeah, it looks like we're getting Intel now. Here is the red headline on the Bloomberg terminal. It's their third quarter look ahead for revenue. They see it between $15.8 billion to $16.8 billion. That is above the estimate of about $15.06 billion. So healthily ahead of those estimates there. When it comes to the second quarter, their second quarter revenue came in at $16.13 billion, well above the estimate of $14.43 billion. And you're seeing beats across the board here when it comes to second quarter adjusted EPS, 42 cents. That is double the estimate of 21 cents. So a beat and raise quarter from Intel. And take a look at the shares right now, higher by about 5% after hours.
Yeah, listen, investors were expecting a lot. This stock has been down nearly 30% this month, so making it among the 10 worst performers in the S&P 500. It is still up about 171% year to date. We heard the president making some comments about the investment in Intel earlier today. Company's Capex increase mainly on equipment, increasing capital spending for 2026 and 2027. The CEO, Lip-Bu Tan, speaking in an interview, so our Bloomberg team on it. And the CEO saying demand outrunning supply, saying production improving quickly. Investors, Tim, I got to say, seem impressed right now. Stock is up almost 4% here in the aftermarket.
Yeah, we're getting more commentary, too, from Lip-Bu Tan, the CEO of the company, in the press release saying that AI is driving unprecedented demand for compute. And as we continue to execute, Intel is well positioned to capture sustainable growth across our CPU franchise, advanced packaging, vast wafer foundry network. He says our Q2 results represent our strongest revenue growth in more than 15 years, enabled by greater speed, accountability, and customer focus. Shares of Intel up close to 5% in the after hours as we speak. The company says the foundry business has multi-engagements and that production is improving quickly.
Yeah, Tim, one thing to keep an eye on, though, we did see options implying a move of about 12%, so 5% now, 6.5% rally post-market. It'll be interesting to see if they maintain or extend gains as management gets on the call with analysts and investors, just given, again, the fact that, to Carol's point, stock down about 30%, but still up, Katie, well north of 150% year to date.
Yeah, and absolutely. I mean, if you take a look at the long-term chart of Intel, it's pretty amazing over the past 5 years. You had to just take off like a rocket, and it's a really interesting story because we know that the U.S., of course, has invested in Intel. We know that that is a big piece of their turnaround story, but it's a turnaround story that they appear to be executing on, especially as Carol, you mentioned that they say that demand is outpacing supply, and that's a good problem to have.
Yeah, I'm looking at Ian King's reporting as we speak, a story out on the Bloomberg. The outlook underscoring Intel's gains with data center customers, which are clamoring for chips to satisfy demand for AI computing. Sales in that segment soared 59% last quarter. Thank you, Ian King. More than double the pace of Intel's overall revenue. So again, keep in mind the CEO took the reins just about last year or so, working to position Intel as a key beneficiary of AI spending. So, Bailey, we know that they've been working on a lot. They got a big boost by that U.S. investment, but it looks like some of the changes and some of the efforts are paying off.
Yeah, and we are keeping an eye just looking at the semiconductor ETF ticker SMH up right now about 1%. So it does seem like at least the worst fears are off the table and investors maybe dipping the toe back in some of these semiconductor stocks. But again, Tim, this has been a market where you look at the stocks, it's up 5% one day and down 4% the next. It'll be interesting to see what happens tomorrow and as we carry on through earnings season.
Yeah, just to rehash some of these numbers, the Intel says the foundry business has multi-engagements. Shares up right now by 8.2%, bouncing around a little bit. Production improving quickly. The company's CFO says there's plans to raise Capex from $18 billion to $20 billion for 2026. Lip-Bu Tan in an interview saying that demand is outrunning supply and also that Intel is increasing, Capex spending in 26 and 27. Capex increases mainly on equipment.
All right, guys, we're going to continue to track this one as it continues to build momentum in the aftermarket. Now up Intel shares about 9.5% here. So investors certainly liking what they got. All right, that's a wrap. Our cross platform on radio, TV, YouTube, Bloomberg Originals. Katie and Bailey continuing there on the close on TV. Tim and I back here continuing on Intel on Bloomberg Business Week Daily on radio. We'll see you again, same time, same place tomorrow.
And coming up, we'll dig deeper into Intel's earnings and what they mean for the broader chip trade with Jay Goldberg. He is senior semiconductors and electronics analyst over at Seaport. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Bailey Lipschultz. Ending another day in the red. Let's take a look at what happened with markets after the bell. S&P 500, Katie, down more than 1%. Big drag, big tech. NASDAQ 100 down closer to 2%. Also keeping an eye, that's where the Philadelphia Semiconductor Index ended the day down 0.5%, but that obviously was before Intel crushed earnings and right now is rallying sharply higher. And Katie, back below $100 a barrel on Brent crude, but we had been sitting with a 3-digit number for quite some time.
Absolutely. Well, let's take a look at what is going on with Intel. That post-market momentum just building right now, higher by about 8.5%. That's after their forecast shattered estimates, really fueled by what we're seeing when it comes to data center, the numbers that Intel is posting there. Sales in the data center segment soaring 59% last quarter. Let's get right to it with Bloomberg Tech co-host Ed Ludlow. He joins us live on the heels of a conversation that he just had with Intel CEO Lip-Bu Tan. So, Ed, talk to us a little bit about this, because I know that one of the things he told you was that they have demand outstripping supply, and that's a pretty good problem to have.
Well, the distinction is last quarter they left a lot of money on the table because they could not get the CPUs into the hands of customers that the demand merited. So the situation is still that demand is growing faster than supply, but supply is still growing. And like the massive outperformance, even at the low end of the sales forecast for this quarter, right, you're beating consensus. So the market is a situation where CPU specifically is taking off for Intel. A lot of their top line performance is answered by that. And in the quarter gone, that unit's growing 59%, double what the rest of the business is growing at. So they have found their place in that market, but what they're battling to do is improve their own operations, their own foundries and their own processes, so they can get the CPU product that people actually want out there into the real world.
Yeah, no, it's a good point to make that, it's a happy problem to have, a champagne problem to have for now, but quickly it could turn into a different situation here. Talk to us a little bit, though, about what we're seeing when it comes to Capex. Of course, that has been the laser focus for investors, particularly when it comes to big tech. What did we hear from Intel?
Okay, so from CFO Dave Zinsner, they are going to raise the Capex guide for 2026. Right now it's at $18 billion. Dave told me that it can go up to 20 billion, and they'll communicate the specifics of that on the call. And in general, they don't often give numbers a year in advance. But Capex in 2027 is going to be meaningfully higher than it is now forecast to be in 2026. The main point is that Lip-Bu Tan is very cautious to deploy capital. He wants to be certain of a return on that Capex. But they have a lot of agreements in place which extends to the foundry business. They booked them in the first 2 quarters of this year. They have a very good sense from customers what the demand is, so they are willing to deploy the Capex for capacity. They're not going to put that money into what they call space, not new sites, new fabs, new facilities, but they will upgrade and add to the tooling. So this Capex is going to equipment, it's going to tools, but it's still a bullish signal from them on the direction of travel in the semiconductor space.
Ed, we saw reports a couple days ago that the company was planning layoffs within its data center group. We have earnings, or the earnings call will kick off at 5 o'clock. Is that something you expect to be addressed? Are we anticipating any type of update on headcount?
Yeah, maybe. I mean, again, remind ourselves that the data center business is high flying for Intel. It is the outperformance. So why would they cut roles in that division? And the way that both Lip-Bu, the CEO, and Dave Zinsner explained to us is like, look, this is normal. They have quite a few new leaders at the top of Intel's organization that Lip-Bu Tan has put in place. They have done reviews of each business line. They have cut various roles for improvement's sake. And they made a really big point that they try to hire as competitively as possible, increasingly focus on some of the veterans of the industry. So to them, this is kind of not a correlated thing. The data center business is doing really well. They're trying to improve it through efficiency, and reducing workforce is a part of that strategy.
Edward, just a quick question here. CLAC and Applied Materials both outperforming after the print. Is this the earnings results that the entire industry really needed to see?
Well, look, we know the stories. You know, AI demand means demand for CPUs as well as GPUs on the data center side. That's why Intel's doing well. On the chip equipment side, if you're going to build lots of new capacity in the United States and around the world, you need the equipment to fab those chips. If TSMC is telling you, like, this is our picture, then all of the chip equipment makers will also follow in the coattails of that. And it's a completely non-surprise in that respect.
All right, Ed, really appreciate your reporting. That is Bloomberg Tech co-host Ed Ludlow breaking down his conversation with Lip-Bu Tan. Let's dig deeper into those Intel earnings now with Jay Goldberg. He is senior semiconductors and electronics analyst over at Seaport Research Partners. Jay, great to have you with us. And to pick up on the conversation that we were having with Ed, you think about the supply-demand imbalance right now for Intel. It's something that the company is pretty happy with, the fact that they have more demand than supply. But when do you think that sort of equalizes here? Do you see any evidence that that could happen in the quarters to come?
I think they're tracking well for that. Like you said before, it's a champagne problem to have too much demand, more demand than they can supply. This has been a sort of persistent problem for them the last couple quarters, but last quarter they indicated they should clear up by the end of the year, and I think they're more than on track to do that. And I think there's positive signals for what that means for next year, where they can actually fully capture all the demand that's out there for them.
Mm-hmm. And, at the risk of leaving money on the table, I mean, who are Intel's competitors here? When you think about the current landscape, who is their biggest, worry ward at this point?
I think for their business today, the biggest competitor is AMD. I'm actually at an AMD event today. Lisa Su, their CEO, gave a very strong keynote. They have a lot of traction as well. I think for both of them, the market is growing so strongly. There's room for everybody. We don't have to worry too much about market share because the market is growing so quickly and there's so much demand out there.
Well, walk us through kind of the expectation, though. Again, calling out that CLAC and Applied Materials are both up more than 2% post-market. How does this report and this update from Intel leak over or provide kind of another drive higher, or at least a bounce back for some of these equipment companies?
Oh, it's fantastic news for the semi-cap supply chain. Applied Materials, KLA Tencor, Lam Research, you go down the list, ASML, right? These are those companies. They only have a few customers. There are only so many companies that can buy their sort of best in the most advanced tools, and Intel was the laggard customer for the last 2 years, and now they have that customer coming back. On top of that, they have all the memory suppliers in the world buying up as much equipment as they can make to build out their Capex needs. So it's a good time to be a semi-cap equipment maker.
And just given the volatility we've seen for Intel, for the entire ecosystem, again, down about almost 30% from its peak last month, how much of this rally post-market is driven by either short covering or just optimism around the near term, and kind of what can the company provide that'll get the company back towards those highs as opposed to stuck in this downdraft?
Well, I think some of what's been going on this year is in the first half, sentiment got ahead of fundamentals. And what we're seeing in the second half of the year is companies that have the fundamentals that can match the expectations are going to do well, and those that aren't, are going to be exposed and punished for it by the market. And I think what we see here with Intel and some of the others that have come, they have fundamentals. They have a good story here in the near term, and then you throw on top of that sort of things that got people excited about earlier in the year, sort of long-term Intel Foundry packaging, advanced packaging, those things. Those are still on track and seem to be doing well too. So you have a near-term momentum to carry you into longer-term fundamentals growth.
Speaking of near-term momentum, now you look at shares after hours, higher by about 11%. So really quite a move that we're seeing here, and that was what was priced into the options market. But we're counting down to the call with executives. That kicks off at about 5 p.m. or so, Jay. On the heels of these numbers that we got from the company, what will you be listening out for when we actually hear from the C-suite itself?
I think right now I'm most interested in near-term conditions. How are their new products, their Panther Lake line? How's that doing? What customers are they selling that into? What end markets are they doing well? And then sort of more broadly for the year, what does this mean for margins? How are gross margins going to trend during the year? This company is operating at sort of very below average gross margins against its historical averages. And I'd like to see some room for improvement there. And I think we can get that too.
All right, Jay, great to get some time with you. Appreciate you stopping by. That is Jay Goldberg. He is Senior Semiconductors and Electronics Analyst over at Seaport Research Partners. Now coming up, Intel's ripple effects on the chip space and how these results factor in. We're going to be speaking with Jana Eggers. She is General Manager of AI and Edge over at OMNI Federal on what she sees ahead. This is The Close on Bloomberg.
Yeah, taking a look at Intel, shares up 12%. That's exactly what the options market was baking in. This comes after earnings crushed expectations back at the top of the hour. Now joining us live is Jana Eggers, General Manager of AI and Edge over at OMNI Federal, to kind of ride this semiconductors, party. So great to have you on the program. When we look at this beat, when we look at these expectations, what are you taking away? Or is the semi party back on? Not software. Software party's dead.
I think they're both back on.
Okay.
I'm excited. We have a lot to do on our side, but I love the fact that Intel, part of the story there is the CPU market, which is fantastic because there's a balance between, it's not one or the other, but both. And we have a lot that we can do as an industry, leveraging both types of compute platform. And so I see it as a party for both software as well as hardware.
And that's a beautiful world that you describe because, for the past several months, they've sort of been treated as polar opposites. That has been the pair trade. Depending on the day, you short one, you go long the other. And I do think it's interesting that we're having this conversation now. I mean, what do you think has changed relative to the past couple months where, again, it was seen as that sort of pair trade?
Well, I think some of it you're seeing in the Capex spend that's coming from the, Magnificent Seven, as they said, that they're people producing and using software. They're also consuming the resources. So you have both sides there. And it's not just the foundational models that are doing. So you have people that are building software that are then consuming the chip space. And so I think that's going to be what balances out is this isn't one or the other, but both, and they both have room to grow and options for it.
Mm-hmm. And let's talk a little bit about Capex, because that has been one of the biggest conversations heading into this earnings season. It's been a persistent feature of the past several quarters as well. You saw Alphabet absolutely punished when it comes to their Capex plans. And I wonder how you're expecting it to go over at the chip level. You know, we're starting to get really into the meat of earnings season now. We have these numbers for Intel. How do you think the conversation around semiconductor Capex is going to evolve from here?
Well, you have to remember, they're being punished now, but since 2003, I think there's been about a 400% increase in most of the Capex spend. So this is kind of like, oh, and you want more now? So I do think that that's going to be interesting to see what happens, but we still have a lot that we're consuming, and we have a lot of Capex spend out there that's just normalizing from the last 4 years, I would say. So I would look at it as it's going to be a little bit of a lag for the hardware market, and maybe it's a little bit of time for software to catch up on that. And by the time we get caught up, that hardware is going to be, needing to catch up again. So I kind of think they're doing a little bit maybe of a leapfrog back and forth.
And we actually have a terminal client writing in wanting to know how are they going to pay for the Capex? And I mean, it's a fair question. You saw Alphabet, for example, for the first time posting negative free cash flow. And certainly you've seen that across the board, and that includes in semiconductors, sort of dipping into free cash flow, looking to tap other markets to sort of raise the money. How confident are you that, you know, all of this Capex that is being planned can actually be sort of paid off?
Well, they've had really great margins for many years. And so the question is, does the market believe that there's more opportunity there? And I think they need to get their stories better on that. They need to help people understand what all of this spend is going to do. Think about the olden days when we were talking about cloud spend. And people really normalized that. There was a huge, Capex expense to go into the cloud spend. And we figured that out, went into OPEX, and then we figured that out. How do we control some of those costs? So I think we're still in those very early stages, but I think there's a lot of similarities there that people can look back to. This is bigger, but it's also something we've figured out before.
How much of a concern is it, though, that the rise in Capex is heavily driven by the fact that prices are simply going up and we're still dealing with a memory bottleneck?
Yeah, I think that's a big question to be answered. But what I will say is we're good at figuring that out. Again, we have had bottlenecks in the past that we figure out how do we get around them. I mean, remember, both on the hardware and software side, you're dealing with scientists. And scientists love problems and love to figure them out. And so I would say as long as the business people are leveraging the scientists that are behind all of these products, that's where you're going to challenge them to solve that type of problem.
And I love that for those scientists solving the problems. Jana, great to get some time with you. Really appreciate your perspective. That is Jana Eggers. She is General Manager of AI and Edge over at OMNI Federal. Meanwhile, let's take a look at how markets closed out on the day and some of the biggest movers after hours. Of course, we're taking a look at Intel. Now shares higher by about 12% or so. Again, that conference call kicks off at 5 p.m. It's going to be interesting to sort of track the stock through that. We also have Deckers reporting earnings. They, of course, are the owner of Hoka's, which is a brand that I love. But apparently, traders reacting to those results in a down arrow sort of fashion. Shares down about 3.5%. You also have Digital Realty higher by about 1.7%. This is The Close on Bloomberg.
Well, just a reminder that Intel is up 12% after hours after crushing earnings expectations. And a company that didn't crush earnings expectations, that is IBM. IBM shares closing up 4.4%, but that did come after the company cut its full-year sales outlook on falling mainframe demand. Well, IBM chairman and CEO Arvind Krishna joined Bloomberg earlier on the heels of that report. Here's part of that conversation.
When we look at all the deals that didn't close, I think we have done enough verification, including with the clients, to know that they were very real, and it was a reprioritization of the Capex spend at the end of the quarter. This was pretty confined to, I'll call it the Fortune 100, the deals that were within a subset of those. Now, 1/3 of what didn't happen has already come back. So that tells us that this was a reprioritization and those deals were very real, as opposed to us being optimistic in our projections. And Romain, I would also add, I think that maintaining our free cash flow tells us that we have levers around productivity and conviction and confidence in the business. And that is also, I think, going to serve our investors well. But the next few months will tell us that.
Well, on that cash flow figure, yes, and that certainly pleased a lot of analysts and investors out there, that $1 billion number of projected free cash flow growth, you maintaining the dividend as well. But you've largely done that so far by cutting costs. So that raises the question that if we are anticipating slower growth on the revenue side, does that mean more cost cuts are in store?
The bulk of our cash flow growth over the last 4 years has actually been on adjusted EBITDA. So that tells you that this is mostly through revenue growth. And our model has always been that we are the last dollar is more productive and more profitable than the first dollar. So we've been growing revenue 4-5%, and we've been growing cash flow up in the 7-9%. So that's kind of our model, and we intend to keep maintaining that. Now, right now, if we drop revenue by 1 point, because we said 4 to 5 instead of 5+, we can absolutely make it through productivity. Cost cuts is an interesting question. Cost cuts doesn't always come down to people reduction in headcount. Our headcount has been more or less flat over the last many years. I think there's a lot of third-party spend where we are going to get a lot more efficient with that third-party spend than we have been always.
So, Arvind, I know there's a big focus right now on sort of the clients that sort of did not necessarily materialize in the quarter. With regards to the existing clients that you have, and I'm primarily referring to your mainframe business, I mean, can you share like sort of what percentage of those clients are actually increasing their spending? Is that going up still?
Absolutely. So the current machine is called the Z17. The Z17 has been, from the beginning, which was May of 2025 to today, at 130% in terms of the capacity growth compared to the prior machine. That's one very strong signal, and that's an aggregate. Then you can say, hey, is everybody in there or only a few? 85% of the clients are increasing their capacity, as opposed to the 15 who are not. That optimization goes on all the time, and I would tell you this is probably the best that we have seen in a long time of what is going on there. Software is going to lag.
Mm-hmm. Yeah, software is going to lag. I mean, look, we know the hardware capacity is there. Software is lag, and I understand why it's lagging in the moment. And I'm going to ask you a question, and forgive me if it's a bit unfair, but I look back to the 1990s and whether there are some parallels to some of the mainframe issues that IBM went through back then under a predecessor 2 or 3 times removed from you, John Akers. And this idea that at that time we were going through this paradigm shift in computing and how companies spent and allocated their money. And there was a lot of talk by the CEO then that the issues were temporary, that they were economic, and that they were rights themselves. We know in hindsight that it was much more structural. Why should we now look at this major shift going on with AI and the computation involved in that and think that this time is different?
Well, we have to look at what the clients are doing. I always start there. Our opinion is an opinion. What clients do is what matters. So when I check with my clients, those who do credit card authorizations, are you going to maintain the mainframe? And they go to, well, the resilience, the amount of capacity, the unit cost of it being 5 to 15 times cheaper is important. The big difference from that time, early 1990s to today, Romain, is the cost issue. You could not argue that the mainframe was cheaper on a unit cost basis for the workloads that are moving off than at that time the mid-range computers. I'll call it the whole Unix. It wasn't really client server. It was Unix taking the workloads off in the early 1990s. That issue you have to look at. If there is a cheaper alternate for that workload, I'll sort of look at you and say, that means in 5 to 15 years, it will move off. But that's not the case. Right now, for the workloads that are on, we can show the clients that it's 5 to 15 times cheaper to keep it on the mainframe. They're not, but that's not all workloads. That is workloads that need protection, that need resilience, that need the burst capacity that comes. And so for those kinds of workloads, the mainframe is the architecturally superior platform. That was not the case 30 years ago for the workloads that did go off.
And our thanks again to IBM Chairman and CEO Arvind Krishna. Now, another big stock story today is, of course, Tesla. Shares tanking 15% after yesterday's earnings for its biggest one-day drop since March of 2025. Joining us live with more is Bloomberg's Kara Carlson. Kara, great to have you with us. So we heard from Elon Musk yesterday saying that this is a massive Capex year, but as we've seen in the shares today, that's not necessarily what investors want to hear when you have profit falling well short of expectations as well.
Yeah, definitely. You know, spending's been a big topic this year for Tesla. There's a lot of concern about both under and overspending. They keep projecting these very high Capex numbers that, you know, is pretty unusual for Tesla. And then there's also some investors that would actually like to see them invest more in AI and actually see some results come from the areas they're investing in.
And I mean, what is the path forward? I mean, it seems like Elon Musk, of course, is very, very focused on AI, still committed to the hopes and dreams there. But I mean, what do investors want to see in the interim, especially when it comes to the actual car business?
You know, the car business has been less and less of the focus, especially the last few years. This quarter, we did see actually record quarter two sales. You know, it has been recovering. It's been actually kind of helping you know, fund the business. But the AI business in Tesla's sense is much more on robo-taxis, on Optimus, its future humanoid robot. And those are areas we're still not seeing a lot of concrete progress in. And that's an area investors are getting a little frustrated in.
Well, that's the big question, right, Kara? When I look at 2027, is this a story that investors are buying on the idea that full self-driving is the future? Is it robo-taxi, or is it that there's actually going to be a real Optimus product that can be shipped to your front door and actually help you with tasks?
You know, I think all of those areas are areas Elon Musk and other people from Tesla talked about last night. I think there's still big areas of focus. But what they started to kind of lay out last night was, you know, these are going to be much slower ramp-ups than maybe many people are hoping for. We didn't get any new robo-taxi target cities. There's 2 that they were going to reach as early as the first half of the year that they still have not actually expanded to. And it still seems to be very few cars, lower miles than many people would like to see. And then Optimus, similarly, you know, they're still looking at potentially years away from, you know, anything beyond internal training and what they call the Optimus Academy.
Yeah, a tough day for Tesla bulls with the stock closing down pretty sharply. Thanks again to Bloomberg's Kara Carlson. Just want to call out again the fact that Tesla down 15%, ending the day, Katie, at a $1.26 trillion market cap, just shy of SpaceX's $1.56 trillion.
Yeah, it's pretty interesting. I mean, when you think about it now, you have 2 different entry points into the Elon Musk universe in the public markets, and both of them coming under a little bit of pressure in the last couple weeks. Of course, Tesla, one of the big stories today. But coming up, we're going to also take a look at shares of Deckers because they're on the move after reporting earnings. We're going to break down the numbers and talk about the wider retail landscape with Mickey Drexler. He is chairman of Alex Mill and former CEO and chairman of the J. Crew Group. This is Bloomberg. Keeping an eye on shares of Deckers, lower after hours on the heels of their earnings. When it comes to Deckers specifically, it looks like their full year EPS forecast disappointed investors. You can see that in the shares right now. And really, this report comes as consumers continue to battle higher prices at the pump and for everyday items. Joining us now for a look at the retail landscape is Mickey Drexler. He is chairman of Alex Mill, as well as former CEO and chairman of J. Crew Group. Mickey, always fantastic to speak with you. I go to the last line in your notes, and you say the biggest mistake is talking about the consumer as one group. And certainly I'm sure we've all been guilty of that. But talk us through, the different nuances that you're seeing in the quote unquote consumer right now.
Well, it's a weird environment, to say the least. And I think we're all having a difficult time, happy, not happy, worried, worried, worried. So what I see, and actually I like what I see, I think more and more product is the thing. Nice product, good quality, well made, and fairly priced. And I think the consumers, when they shop sale, they show up. But I don't think there's a loyalty in the sense for sale. And I think they're saying, is it worth it? Should I buy it? Et cetera. So I think the shoppers, again, I speak to my friends who run companies in the business, but what we're seeing, and I'm delighted, is product is the issue in terms of business. And I think it's product in every category and quality, and not just being on sale. I think sale has taken over the industry too often. A friend of mine said yesterday she bought a bunch of things at one of the well-known brands, and she said, promise me it will not go on sale tomorrow.
Right.
Which, and then the salesperson said, well, if it goes on sale, you're entitled to the credit. Well, that's a nice way to shop.
Right.
I think people have to trust the retailers or any business they do business with. And trust is a big thing. I think they have to feel, for us, an emotional connection to a brand, and not just as a commodity business. But I think people are really worried a lot. And I think the biggest marketing word now is affordability. But they're willing to pay for quality and integrity of merchandise.
Well, Mickey, you mentioned the fact that you talk to leaders of these companies. Are they seeing a push towards in-person shopping? Are people instead preferring to buy goods online when they are potentially sale hunting?
The truth is, like, we run 2 sales a year, and I check to see the customers who buy sale are usually not they're not our regular price customers. There's a great amount of professional shoppers out there who know that everything eventually will go on sale. And I find I don't trust sales because there's a high markup, you put it down on sale, it goes back up. I think that hurts the trust and loyalty of a customer. And so I think, we're really only an online business. We have 2 shops in Manhattan and 1 in Martha's Vineyard. So, we're online, but our retail 2 shops are doing well.
Well, Mickey, I hear what you're saying. When it comes to promotions, we could be entering a too promotional environment. But you have to imagine that for a lot of retailers, when they take a look at sort of the sense on the street, that they feel like that's the only lever that they have to pull when they're sort of competing with pocketbooks for all of these other expenses that we know are going higher right now. And I wonder, does it have to be mutually exclusive discounts and sort of building trust and loyalty?
Well, not necessarily, but I've always believed that the loyalty should be every day to your best customers. And if you look at, it's interesting. The other day we had a discussion, 2 great companies, TJ Maxx and Costco. You will not see the pricing jumping up and down. They put out the right price at the right cost, and that's what they make. And they're 2 great big companies, as you know, and long-term great companies. But I think that it's a matter of raising prices to then afford to be able to show it's a good sale instead of day in, day out pricing. And, I watch the news shows all the time, and every ad they have is take 50% off here. Who believes that?
Yeah.
You can't make money taking 50% off for 60 or get it free. So, but that's my own personal opinions, and I've always followed that in my experience. honesty, trustworthy, fair pricing, nice goods, and no multiple sales except a couple of times a year.
Well, Mickey, you mentioned the fact that you have some brick and mortar stores, but are also predominantly online. I'm just interested in how you think about the evolution of kind of the shopping experience, because I talked to some founders and CEOs at some of these companies, and they talk about, oh, we are implementing AI, so when you come in the store, we know who you are, we know what you want to buy. Is that the future of shopping, or is the future of shopping going on ChatGPT?
I don't think. I think talent, creativity, and vision is not going to be taken over by AI. Now, I have fights with my friends about that, but I never heard AI. We use AI. Forecasting, it's great. Replacing certain jobs, it's good. But it won't replace vision, and it won't pick best colors, and it won't design clothes, which everyone argues with. But our business is a touch and feel business. AI, I think, and again, I'm not a technician or technologist, but I think AI is not going to solve all our problems. It will cost us, America, jobs where it can be replaceable by AI. But I'm a big believer in the design, style, and integrity of product will be driven by people who have vision, are creative, and they'll also have a great team of AI people and everything else.
All right, Mickey, have to leave it there. Always fantastic to speak with you. Appreciate your time. That is Mickey Drexler. He is the chairman of Alex Mill and former CEO and chairman of J.Crew Group. Now, still ahead, signals from the upcoming United Nations Town Hall as it searches for a new Secretary General. UN Foundation CEO Elizabeth Cousens will join us live next. This is Bloomberg. Tonight, 6 candidates will speak in a town hall as the UN moves to pick a new Secretary General. Former presidents, current dignitaries, and the current IAEA Director General are among the candidates. But for anyone up to the task, they will face a critical U.S. government, a narrowing budget, and a new period of global conflict. Here to tell us more about this, I'm pleased to say we're joined by Elizabeth Cousens. She is president and CEO of the United Nations Foundation. Elizabeth, great to have you with us. And, you know, before we get into the specifics of the candidates, just give us a lay of the land here, because as I sort of laid out here, you think about all the different cross currents hitting the United Nations right now. It certainly seems like a big and urgent job at this particular moment.
Absolutely. And Katie, great to join you. Look, this is an extremely important race. It's always been consequential for the UN. There have only been 9 Secretary Generals in the UN's 80-year history, but this one comes at a uniquely defining moment for the UN and for everything it stands for. Part of that's about budget constraints, which are significant. Part of it's about inconsistencies and questions about the UN's delivery. They need to be addressed. Part of it's because of years of accumulating mandates and fragmentation that have led to some loss of focus at the UN, but mostly it's because the whole premise of the UN as an universal institution committed to the idea that power should be exercised with restraint, that there are rules of the game that should apply equally to all of that is under unparalleled strain. And as we look out at such a fierce global horizon, whether it's the number of conflicts, highest number since World War II, basic planks of a prosperous global economy like freedom of navigation coming loose, rising inequality, you name it. We have a yawning gap between global challenges and the capacity of our institutions to address them. And that puts such a fine point on this race for Secretary General as the leader of an institution that's the singular emblem and practical expression of our capacity to get things done by working together. It's the one place where every country has a seat at the table.
Absolutely. And, you know, you think about this moment as time. You mentioned the enormous pressure that the UN is under. A lot of that pressure is coming from one President Donald Trump, who, as I mentioned, has been very critical about the United Nations. And when you think of that and you think about the relationship that needs to be managed between the UN and the President of the United States, I mean, how does that inform the type of leader that the body should have?
Well, look, the UN leader, the next Secretary General, needs to have a good working relationship with every permanent member of the Security Council, including the United States. I mean, the United States was really the chief underwriter of the UN from its very founding. So that's essential to have a productive working relationship with not only those 5 members of the Security Council, but the entire membership of the General Assembly. This is the person who leads this institution. But I think it's important to remember that the UN has actually never really or rarely worked in a benign environment. For most of the UN's 80-year history, it has operated in extremely ferocious geopolitical conditions. Just think about all of the decades of the Cold War. That was not a happy time. That was not a time when everybody got along. And often Secretaries General and their teams had to navigate among very, very difficult tensions and constraints. So this time is uniquely challenging. I think we can all recognize that. But I think that's par for the course of this job. And the candidates who are coming in to say, I think I'm ready for it, understand the environment that they'll need to navigate.
Absolutely. Well, Elizabeth, really appreciate your perspective as we, of course, count down to when we might see that next leader selected. That is United Nations Foundation CEO Elizabeth Cousens. And stay with us on Bloomberg TV, because just moments from now, our own Romain Bostic, as well as Haslinda Amin, will be moderating the UN Town Hall that is live from New York City. That coverage kicking off at 5 p.m. Eastern on the dot. But that does it for us here on The Close. But as I mentioned, stick around. We're live from UN headquarters coming up next. This is Bloomberg.